The whole goal is to avoid psychological biases. As humans, there are lots of cognitive psychological biases that we fall prey to, and Quant basically eliminates all of that. We are fully systematic. So, what that means is that the market sentiment or the market signal should also be part of the Quant process. The moment you marry your long with some of these short positions, it can be broadly called long short. Clearly, in the last 5 years, there's been a exponential growth. It's like gone maybe from 1,000 crores to at least 50,000 crores or something. But it all boils down to education of the wealth advisors, the IFAs, exchange, and the mutual fund entities have to drive that.
Hello and welcome to another episode of Ask InCred. Joining us today for a sharp dive into the cutting-edge world of quant investing is Rishi Kohli. He's a managing partner and CIO hedge fund strategies at InCred Alternative Investments and a true heavyweight in India's institutional buy-side scene. With over 21 years of decoding markets through data and algorithms, Rishi has built a career turning complex models into winning strategies. From launching some of India's first quant hedge funds to consistently delivering market-beating returns, Rishi has a track record that speaks louder than any benchmark. He's also a sought-after voice on the global stage and a regular on financial news screens. So without further ado, allow me to welcome Rishi. Welcome to Ask InCred, Rishi.
Good morning, happy to be here.
Great. So in this episode, we're essentially trying to demystify quant investing. In general, I think everybody finds it as a very complex and technical subject. So the idea is to kind of, simplify. And I think you bringing, so many years of experience in quant, we thought nobody better than you to simplify these concepts. So let's kick off with the basics. If you could just, simplistically help explain the concept of quant investing for our viewers, because it's a rather, abstruse subject in that sense.
Sure. So in a very simple and loose manner, quant is nothing but the moment you do rule-based investing, then it can be called as quant investing. So I'll give you a few simple examples to explain that. So for example, traditional, fundamental fund managers would look at companies, look at the earnings, the growth, the margins, etc., and then have their own frameworks on deciding whether to invest or not in a company. As a quant, when I do the same thing, I want to invest in companies or do long-only equities portfolio, we do something similar. The only thing is it is completely rule-based, right? So I will say, okay, if earnings growth for the company over the last few years has been more than 20% annualized, then it will get filtered. If there's an operating margin greater than 20%, then it will get further filtered. So like this, the simple way is to just keep filtering like that and come to a portfolio of stocks. Obviously, you can go as more complex as you want to, but that is sort of the difference between traditional and quant. Not very different when you're looking at similar type of portfolios. It's just that then you stick to the rules. You don't really take ad hoc decisions otherwise. So whatever is coming through all my quant filters, screeners, whatever you want to call it, will then come into my portfolio.
Got it.
And similarly, the other school. So this is more fundamental, let's say, some price-based or technical or statistical kind of things, right? A simple technical analyst or a chartist may say that, okay, we'll just look at certain patterns in the market. Instead of that, on the quant side, you're actually defining those mathematically.
Okay.
And then saying that, okay, we'll invest or not invest or trade or not trade.
So essentially, there's a lot less subjectivity in the decisions that are taken.
The whole goal is to avoid psychological biases, right? As humans, there are lots of cognitive psychological biases that we fall prey to, right? And quant basically eliminates all of that by one rule-based.
The intelligence is in the kind of criteria that you set. That's where your expertise comes into picture as a fund manager, right? As compared to the other fund managers.
Yes. So see, the advantage is that you can virtually test millions of ideas and you can go back and actually see how that would have played out in different types of market conditions, get comfort with whatever data you're seeing, good and bad, and then decide on what approach you want. So that is the advantage. The disadvantage in some sense is again a little more psychological, which is that, we'll feel that if we are not meeting the management, for example, of the companies, and how are you getting the full insight? That is what a traditional fundamental fund manager would say. But there is more than enough data, India and globally, that it doesn't really matter beyond a point. And seeing all these different scenario analysis basically adds a lot more value.
Interesting. Now, within quant investing, we hear lots of different strategies, right? There's hedging, there's long short, there's absolute return. Could you just help us understand the basic kind of strategies in this space?
Sure. So, as I said earlier, that anything which can be defined as a set of rules and then you follow that to do your investing or trading becomes, in a broader term, quant investing or quant trading. Within that, of course, there are many, many strategies. So, starting with what everyone relates to is long equities. So, long equities also can be completely via quant, meaning that you can have just rules to decide which stocks and how many stocks you want in the portfolio.
Okay.
And it can be different types of rules. It can be purely fundamental oriented, where you just look at earnings growth, operating margins.
Like, give me an example.
So, for example, I could say that I have this combination of 3 or 4 criteria, that if earnings growth is above a certain threshold, operating margins are above a certain threshold, I have my return on equity, return on capital above a certain threshold, only then I would select the
only those stocks would be in your universe.
So that is not very different from a traditional fundamental manager. It's just that he's using a different framework to decide this, and we are using these strict rules to decide it.
Got it.
Similarly, you can have a momentum factor, right? You can say that, okay, the stocks which have been doing well the last 6 or 12 months are the only ones that I want in my portfolio. So again, you can have many different approaches to long-only investing using different types of quant methodologies. But that is long equities. Then when you want to do long short, again, there can be many different ways you can do it. Again, for viewers who don't know what shorting really means, what it means is that, when I'm going long a stock, let's say I'm going long Reliance, I make money when it goes up by 100 rupees.
Right.
But what if, like the last 6 months, you've seen different stocks and markets fall at different points in time. So that time, obviously, whatever stock you may have, largely you will be flat to negative.
Correct.
But what if you were short that stock, and which means that if it falls by 100 rupees, you make money, right? Obviously, you can't do it via the cash equities market, but you will need to therefore go into the derivatives market.
Correct.
Which means, short either futures or buy put options to profit from that. The moment you marry your long with some of these short positions, it can be broadly called long short.
A long short.
Right. And then within that, there are more intricacies where you can have very low risk strategies being combined. So what is now in India called as absolute return strategies, or even loosely fixed income plus in terms of risk and reward. And then you can have more equity long bias strategies, meaning again, you can have these long equity portfolios.
Okay, so that covered long short. And what about absolute return strategies?
So absolute return is a subset of long short in some sense, because again, you're going long some stocks and short some stocks, or long these stocks and short index futures, or again having different types of derivative and index option strategies itself, where again you're going long and short different instruments. So it is a combination of long and short. Why it is called absolute return is because you're trying to make certain returns every quarter, every year, irrespective of what the markets do. So obviously in a long strategy, if markets are falling, again, like the last many months, then you will lose. But in an absolute return strategy, you will still make money. So what has happened is that in India, there have been a few funds which had scaled up, and therefore that category got created and well known among at least the larger family offices. And therefore, people use it for a replacement to some allocation of fixed income. Because, post fee, post tax, if you can make 7, 8, 9%, then it's very attractive while being a low risk strategy.
Interesting. So I think you explained the long only, the long short, and the absolute return. So could you just help us understand the kind of risk return profiles of these different strategies?
Sure. So on the lowest risk and return side is absolute return.
Okay.
And there, as I said, the goal is to be fixed income plus kind of thing.
So kind of like
post fee, post tax, if we can be at 7, 8, 9% in that zone, while being liquid, right? So the point is that, it replaces the allocation you have to liquid funds, short-term bond funds, etc. So obviously that is a very high return for that category. and the risk being almost as low. So, typically you'll have one losing month in a year, which is just 30, 40 basis points. So not very different from a short-term bond fund.
Interesting.
So, which is why that is interesting. And then you have something which is over time in India come to be called as equity minus. So you may have slightly lower returns than the equity markets, but with much, much lower risk. So let's say you can target 15, 16% annualized returns at a gross level, but with only single digit risk, unlike the markets where it can obviously fall 10, 20%, right? So that is also interesting for different portfolios. And then, of course, it is more equity or equity plus, right? Which we said that one can be just simple, plain long equity using different factor models or different techniques on the rules that we are applying on the fundamentals. And a variation of that could be where you're doing that, but also doing a little bit of hedging. So that if at least there's a tail risk event in the market, it falls by 20%, I have a hedge at 5 or 10% away, then I will not fall more than that.
So there's a downside kind of protections in it. So all of these are liquid, is it? All the quant funds?
Yes. So in India, we are typically mostly all open-ended, which means that, every month you have the option to exit. And of course, these are all trading liquid instruments, largely, the large cap stocks or the larger mid cap stocks or futures and options, which is even more liquid since India is the largest derivatives market in the world.
Oh, it is today, right? Yeah. And these are all what we're talking about is Cat 2 AIFs, right?
Cat 3 AIFs.
Cat 3 AIFs, right. Could you give us some perspective on the kind of growth we've seen in the AUM in quant investing in the last?
Yeah, so unfortunately, there is, no single statistic on the various quant funds because what happens is that there are some quant funds on the long only side in the mutual funds.
Okay.
And then there are long short quant funds like ours and other competitors and other players in the industry. And then there is this whole world of passives, right? Which obviously normal Nifty or banking index funds are, not that quant because they're just following a traditional
Correct.
index. But there are many indices now created by NSE and BSE which are based on different rules, momentum, low volatility, value, quality, etc. So if there are funds on that, then even though they are passive funds, I would put them under quant funds.
Interesting.
So there are many different categories. Data on some subsets are there, but not fully there. But having said that, clearly in the last 5 years, there's been a exponential growth. It's like gone maybe from 1,000 crores to at least 50,000 crores or something. There has been a big move and it's just the beginning. So the next 5-10 years is going to see tremendous growth in this space.
So I think the message would definitely be to kind of, even retail investors to explore quant maybe in a certain, section of their portfolios to see how it's.
So what has happened is certain sections of retail have dabbled in it due to the derivatives market. Now we've seen a lot of data from SEBI that, they've been losing in the derivatives market, etc. But the interesting statistic is that within that retail segment, the ones who have been using algos have actually been the profitable ones. So there is some subsection of the data which suggests that, which means that if you are rule-based and going into derivatives, even for retail, you can make money.
Okay. But I was talking about the fund-based route. So what you're talking about, the direct derivatives market.
That or through the algo, there are certain algo platforms now. SEBI has cleaned up some rules there over the last year.
Okay.
So not till now, but I think going forward, there can be very good scope on that. And of course, on the retail, on the mutual fund side, as you mentioned, there's a larger scope, obviously, because what has happened is that till now, they were the traditional mutual funds which have been around for a very long time. And obviously, they had started some of these passive funds to begin with, which could be called quant or rule-based, as I just mentioned. But in terms of new indices or new products, there was not much innovation there. But now you are getting many new mutual funds starting, which are either focusing on passives or on systematic and quant strategies. So with all of this starting over the last 1-2 years and now in the next few years, we are seeing many more starting. So I think, the next few years, there'll be a lot of innovation on that side. And that will give the retailer a chance to participate on the long equity side, which is obviously the bigger market.
Okay. And are there people that you've taken inspiration from in your journey of quant investing? Like who would you say are like the gurus or any books you think that are really...
Yes, definitely. So the biggest name is obviously Jim Simons from Renaissance. And there's a book which came out a few years back on him called The Man Who Solved the Market. Because interestingly, his is like the best track record ever. And it puts the Warren Buffetts to shame.
What do you
Because
say?
over a 30-year period, or maybe more, at least 30, 35 years, he delivered like a 60 to 70% annualized return.
Ooh.
And profitable every year.
Oh my gosh.
So it is like mind-boggling and no comparison at all. No one comes close to him, and built entirely using mathematicians and scientists, right?
Wow.
So he was a code breaker for the U.S. government in the Cold War, etc.
It's incredible, right? I mean, to think of how data could actually, like a model could actually beat any sort of, subjective.
So his is the most mind-boggling story because, as I said, he was a code breaker, he was a scientist, he was a mathematician. He was one of the biggest names in the geometry world globally, and he applied those principles to the markets and built a team which was like him, right? Academicians and maths and science guys, and they achieved this. And then even before him, so very interestingly, there's a name called Ed Thorp, Edward Thorp fully, but he's called as Ed Thorp. So he's actually the first quant who achieved a lot of success. But less people know about him because he sort of retired 20 years back. But his was the first quant fund, and he initially used a lot of probability and statistics in the casinos. So he used it on blackjack,
Oh,
right? And he beat the casinos. He made a lot of money there. He was banned from a lot of casinos
wow.
because of that.
Okay.
And then he said, okay, what do I do next? So let me apply these principles to the markets. And then he made like 20% annualized returns over 20 years while being market neutral, which means no exposure to the market.
Gosh, those are fantastic. I think that calls for a movie for sure.
Yeah. And then another interesting thing related to Ed Thorp before we move on is he actually gave some of his ideas to Ken Griffin, who founded Citadel. And Citadel started using the original learnings of Ed Thorp and is now one of the most successful hedge funds in the world.
Fantastic. I think that's very insightful, interesting. In fact, I mean, I think you are definitely at the forefront of kind of promoting quant in India. And I believe you've set up Laksa, which is Lambda Quantitative Strategies Association, the first of its kind non-profit organization in India. Tell us a little more about it and how the response has been so far.
Sure. Yeah, so it has been on my mind and on the mind of some friends from the industry who are also quant guys to set up something like this to bring the entire institutional quant community together in India. So what has been happening is, as we discussed, that some of these things have been growing only over the last few years. Now, I have been trying to do this for 15 years, but it's really started only 5 years back, really, the whole buzz around it. So we thought that a lot of activities are happening on the retail side of the market just because of some retail algo platforms and other things. But on the institutional side, which is obviously the more meaningful side of the market and more data driven and more scientific, there's actually neither any events happening, nor any learning programs, nor any exchange of ideas. Whereas globally, if you go to the largest markets, which are US and Europe, you have these quant associations and quant clubs which keep meeting every month, exchanging ideas, brainstorming, etc. And that really leads to the development of the industry. So we have been feeling for the last few years that this is required in India now that that inflection point seems to have come. And that is where I and another friend got together and, finally ended up forming that association last year. And yes, so far we've done a few events, a few webinars, and a few learning programs to begin with, because those are what are required to initially bring the community together. And the response has been far better than we thought. So whatever events and webinars we did, we had to sort of close registrations a few days before.
Oh my, that's fantastic.
And the flagship event we did in Mumbai in January this year was packed right till the last session, which we don't see even in normal
That's
events.
such a positive sign, right? Yeah, that's great. That's great. Could you actually now, I think we've spoken a lot about the strategies, but what really goes into creating a quant model? Like, could you kind of like walk us through in simple steps, if at all that's possible?
Yes. So see, it initially starts with some market observation or some hypothesis, to put it broadly, right? And then you sort of frame it into a set of rules. And then you go and create a program and a set of codes around those rules.
Okay.
And then you go and apply it to the markets, going back as far back as possible on the data. Because the whole goal is that the more different types of market conditions I can test my rules on, I have a better sense on when it can do better and when it can do poorly. And overall, over the longer term period, does it really add value or not compared to whatever else I'm doing? So that is the broad concept. And within that, of course, the key things are, you need to be a keen observer of markets, keep getting these new ideas, because also, there are other people looking at the markets and getting ideas as well. So a lot of times, the new ideas will last and give you some alpha for a few years, and then they will fade off. So you need to keep reinventing the wheel and keep, thinking of new ideas and keep testing on the data. Data is very important, and further back you can go, the better comfort you can get around the results. So if for the US, for example, you can go to 100 years of data. In India, you can only go 20, 30 years. So a lot of our models will go and even test on the US markets to get a sense of what it could have done, say in the 70s when inflation was high. You have all this buzz around inflation nowadays, but you don't have a parallel in the last 20 years.
Yeah. But I'm curious, like, how do you kind of do all of these back testing? Like, is it like there are specialized systems to kind of, do these tests? Or, I mean, do you need a combination of tech talent plus
Yes.
traders to kind of do this? Yeah.
Correct. So you need tech talent, and ideally, the serious quant funds would build internal teams and internal infrastructure, because you don't want to be dependent on external sources or disclose your rules or your alpha ideas to the external sources. So you will all build it internally. Initially, when teams are small or when costs you need to keep in control, there are firms which would take some external help, and there are platform providers and even people like Bloomberg. They have certain quant side of the platform also. But typically these will be very expensive, and again, you'll be disclosing certain ideas to them. So it's better to build it internally. And obviously we use a lot of Python programming, for example.
Nice.
So you will need Python programmers to help out the quant research guys.
Oh, yeah, which brings me to a very important question. Like, AI must be helping you guys in a big way. I mean, how does
So AI is in some sense not new for quant guys.
Yeah, it's
And in some sense it is new. So I'll explain what I mean by that. It's not new because people have even 20 years back tried to apply AI to quant models in the US, of course, which was more advanced, not here. But the results had been very mixed. And the reason for that is because in quant, you have to be very sensitive not to overfit the data, right? The data fitting, overfitting is a big issue, which means that if you give me any data, which I don't even know about what the data is, obviously I can reverse engineer an equation that fits the data.
correct?
But that doesn't mean it'll work in real time, right? So that's a big problem. And there are ways statistically to eliminate that bias. So what AI does indirectly is that when, we are applying it to a corporate strategy, there can be only a finite number of truths. So obviously you'll get interesting results. But in markets which have infinite variables and infinite possibilities,
Yeah.
so it ends up somewhere curve fitting and somewhere not getting those results that you need. So in my opinion, based on tests we have done, I think it is very useful, but useful for collecting the database of models that you have, and then overlaying certain rules, very dynamic rules on it, on when to use which group of models and how to weight them.
Interesting.
Because that also is a very big problem.
So it works in a finite scope, is what you're saying. When there's too much of information, it becomes harder. I think, if you had to explain what's unique or perhaps missing in India's current quant ecosystem compared to global peers, what would stand out to you? Like anything that would help you?
Yes. So there are a few strategies we discussed: long only and long short and absolute return. So these strategies, there are some good serious quant players already. But certain strategies are almost completely missing from the Indian markets. Two of these which come to mind are market neutral and CTA, or managed future strategies is what it's called globally. And I spent many years actually doing managed future strategies, and it didn't take off much in India at all. And there are certain reasons around that. So these two things can really diversify investors' portfolios, whether it's a retail or a large family office. But you virtually don't have much choices right now in India on these strategies. So I think a lot more work on those need to be done by the quant players in the industry. It also requires a slightly different mindset. So you'll need a lot of new ideas on the table, which is where probably the youngsters come in, because they can come up with some new ideas without having biases on what is already there.
One interesting question. I mean, the channel is called Ask InCred, so we take questions from our viewers before the show. One question was, personally, how would you navigate situations where the model gives a strong signal, but the broader market sentiment seems to be completely disconnected from it.
We are fully systematic. So what that means is that the market sentiment or the market signal should also be part of the quant process. I can explain it with an example. You can have a long portfolio of stocks, again, which are rule based, whether it's fundamental, technical, as we discussed earlier. But you can also have a market signal overlay. So when that market signal overlay gives you an orange, let's say, then you can go to 50% exposures on your long portfolio. And when it gives you the full red signal, you can go to zero exposures. So the market signal can sort of be overlaid on the entire portfolio of stocks, however you may be constructing it. So traditional, fully systematic quants would do something like this.
Some tips or I think some guidance that you would like to give. One would be to the retail investors when it comes to kind of exposure they should start taking to, say, quant-based mutual funds or I think SIFs, which are also coming out. And then one for the institutional and HNI, UHNI clients. Do you think they also have, shown that confidence in quant-based strategies, or do you think we need to do even more, like we need to penetrate those portfolios even more in the coming year?
Yeah, for sure. I think for both segments, a lot more penetration is required. And for that, a lot of education is required, obviously. On the UHNI family office side, a little bit of work has been done because of these absolute return funds and long short funds, because these were there in the alternative investment fund category,
Right.
which was for that segment, right? So a little bit of education has been done, but there's still a long way to go, I think. Like I mentioned, market neutral, CTA strategies, even long only quant, the wide spectrum that is possible, even they don't fully are not fully aware about it. Retail side, of course, there's even more education that is required. And apart from some of these trading algos, I don't think, they're aware of anything else. And obviously on the long side, long short side, a lot can be done through the mutual fund route, through the SIF route going forward. But it all boils down to education of the wealth advisors, the IFAs, exchange and the mutual fund entities have to drive that. And obviously Laksa will play whatever role it can in association with these.
That's exactly why we are doing this show as well. I think educating people on, all of these new concepts around
Yes,
finance.
very required and it's a great initiative.
Great. Thank you so much, Rishi, for your time.
Thank you.